Hello, everybody. Welcome to week 6 of 2026. This is MindPrint Hash with Matt Dines and myself, Cameron Otsuka, as always. This week, Matt has kind of called this the liquidity setup week. It feels like there's not maybe a huge amount of new news coming out day to day in the last couple of days, but obviously a few undercurrents that I think are going to transition into bigger waves as we go into the next couple of weeks here. So, to kind of quickly go through the three topics for the week. Number one, US ISM is on a heater. Matt will definitely go through and explain that through the charts, what is going on and why that's the case. Secondarily, the Japanese elections, general elections, come up on Sunday in Japan. For us, that's tomorrow. Sorry, on Saturday. But that is coming up soon, and definitely something to watch in relation to JGBs and liquidity, like we mentioned. And then finally, the painful charts for all of us. Number one on the Bitcoin charts, dumping. And number two, in terms of SaaS, dumping. So let's
Mhm.
get right into this, Matt. U.S. ISM Manufacturing. Walk us through kind of what you're seeing. This print just came out, so walk us through what the news is there and why it's important for the week.
Yep. So before we get into those other two more urgent topics, we started this week opening up with the US ISM Manufacturing PMI for the United States. Basically, this is a survey index. 50 is net even. Below 50 is shrinking, declining, contraction. Above 50 is expansionary. So that number came in this week. It was actually a big surprise for the U.S. Real like goods producing economy. If you've been following along with MindPrint Hash the last few weeks, this is not a surprise. We talked about what Dow Theory would say with the U.S. industrial sector, with the XLI industrials ETFs. It's a better representation of the industrials, in my opinion, than the Dow Jones Industrial Average, which includes companies at this point like Goldman Sachs, et cetera. It's become watered down in the 100 years since Charles Dow formulated this index. But what that was supposed to represent was kind of a footprint of equity pricing for the kind of the U.S. manufacturing goods producing sector, and then the sibling of that index is the Dow Jones Transportation Index, which is really the counterpart of moving those goods throughout the economy. So railroads, airfare, ships, etc. Just transportation, and the signal you're looking for. If this U.S. goods economy, if the industrial side of the economy is in a bull market, you should see a confirmation between a breakout of the industrial equities as well as the transportation. We called this out. We said this looks like it's happening. As we enter January, and this ISM print on January, in my opinion, my read of the situation confirms that. So, the economists were surveyed and expected 48.5, which is contractionary, as is always or often the case with kind of inflection points in these key indices. The consensus tends to herd with each other and get these signals wrong. So the fact that they were off by a whole, um, 4 points, and those 4 points were a key range, right? 48.5 and 52.6 is the difference between contracting and a decently sized impulse towards expansion. But as far as what the data is showing on this PMI survey on the manufacturing sector, that looks to provide another confirmation signal. The goods economy within the US is in a bull market, which kind of echoes what we've seen with the backdrop of what this White House has been pitching as far as the statements we've heard from Scott Bessent, for example, Treasury Secretary Bessent. We need to grow our way out of this. We're going to run it hot, et cetera. This is what they mean, and this is an output of what you would want to see with the follow through of the complete laundry list, the docket of policy steps they've made. Between international trade, market access, et cetera. What this means is you've got a growth upturn in the U.S. industrial sector, and so yeah, these kind of signals we're seeing in other areas of the of financial markets. We'll get into those in our third kind of news topic we'll cover with Bitcoin and the software sell off. This is kind of in contrast to those signals where you see liquidity being kind of sucked out into the financial sector as it's going into the U.S. commercial and industrial space. Bring receipts on that. So you've seen us track the Fed H.8 reports. What I look for here is impulse. It's more rate of change and direction as far as where the U.S. banking system is deploying capital. So we've got the asset side and the liability side. We'll start with the assets here. This is the latest weekly report we have, which goes through January 21. So comparing week over week now on the most recent data available, we'll get a new one tomorrow, but we're seeing that uptick in bank lending to commercial and industrial borrowers. So that impulse, I first want to highlight, up 3.2 annual impulse. This is nothing to brag about, but it's the start. If you see the rate of change, just the movement from basically zero, and as you just drag, you shorten your measurement window you're taking that first derivative on, you can see it's moving up and positive, right? So as this trend with the underlying policy continues to work through, you're watching for that kind of segment, that line on the H.8 report to reflect that capital allocation going into U.S. industry, which is bullish in my opinion on the U.S. So we talked about the slowdown in bank credit expansion. Well, it's now also in an uptick, 4.7% annualized rate of change on the smallest increment. You can take that derivative in the H.8 reports. So that continues to move up and to the right. And then you've also, highlight, across the different line items, you call out it's being led by commercial industrial lending. So if you just think through this, what's going to happen? Well, if you're flowing more of your banking capital into U.S. industry, that's manufacturing production, that's output, that is positive for the U.S. economy. So it's a positive story in my opinion. This isn't, despite what you're seeing in financial markets on the underlying fundamentals, this is from a U.S. perspective, from an American perspective, a positive development. It's playing through exactly as you'd like to see it. On the cash reserves and collateral assets, something to note, you've seen a decline in the cash reserve position with banks. This is where the Fed gets into, what it's watching for its just kind of reserve management policy. So you're getting into, these are the aspects I won't touch on too deeply here, but the Fed wants to make sure that the U.S. commercial banking system has enough reserves to settle all the transactions, interbank transactions between each other. So this is where it needs to watch that cash reserves position extremely closely at this point we find ourselves in from the financial cycle standpoint. Now on the funding side, one thing to note, we do have a drawdown in deposits. This is typical. We'll go through the chart here. This is something you tend to see on an annual basis. Just you open January, deposits tend to shrink as households, businesses, et cetera, they get through Q4, which is your big spending quarter for the holidays. You settle out all your, end of year contractual obligations, all of that. You generally tend to start the year off at a low point in deposits. That's something we are seeing. But as you get through tax season, that situate like April 15th in the U.S., the main filing date for individuals as well as businesses, you tend to see that deposit situation start to work itself out. So those are like on the funding side, that is something you want to continue to watch. Right now, banks, the banking system, the commercial banks have leaned into borrowings. It's pretty clear. This is like tapping the debt markets for accessing capital to fund that loan growth into what's largely going into the U.S. commercial and industrial borrower base within the U.S. economy. But at this point, like the balance sheet expansion, it hasn't gotten out of hand yet. So this is still very early in this process playing out. Cameron, any other comments there?
I think that that
With
was a really good explanation for me to just kind of see this whenever Matt, just for the viewers as well, whenever Matt puts up this H.8 report, I'm always kind of like, whoa, what am I looking at? All the colors, all of that. But that was very clear. You can see, you can follow those numbers all the way through and understand how that actually operates.
Yeah. So your first signal, your bank reports, your H.8, it's always 2 or 3 weeks delayed. Your ISM, you only know where you are like in the current month weeks and weeks later, once you get that print after a month. Your earliest signal is always going to be equity markets. So follow those closely. If you had listened to what we were saying, 3, 4 weeks ago about that Dow Theory breakout, this is really leaning into that. And I think as you get into the cross asset kind of volatility we're going through now, we'll talk about that in a bit. The sectors that actually have a structural tailwind in this environment, U.S. industrials may be one example, U.S. small caps, which tend to be more domestic players as opposed to like an S&P 500 large cap, which is going to be more global based in terms of its business footprint. Those sectors in this pullback have been an outperform. So, the tide washes out with liquidity in the setup we'll talk about in a second. But if you have that tailwind at your back, well, you should outperform in that environment. But yeah, just to quickly summarize the charts, demand deposits, I highlighted in yellow here. The next slide. The red is the beginning of the year. We do have a downtick in deposits. That's, hey, you make a bank deposit, the bank turns that around and makes a loan. We do have a little contraction on the deposit front, but I wouldn't worry about that too much right now. As I've highlighted in yellow, you see that same pattern at every turnover from end of year to beginning of the new year. So keep watching. If that doesn't turn around, then we'll have to address it. But as of now, just totally normal behavior. Next slide I want to go to is the commercial and industrial loans. We're still in a little like a flat range that we've been in since the start of 2025. This hasn't even gotten overheated yet. So from like um, just like a market cycle standpoint, if you're early on, in the process, like what inning are we in? First, second inning of this thing playing out. We're not even at the high of where we were on commercial industrial lending in the US banking system relative to kind of the plateau from all of 2023 and 2024, let alone the big surge of March 2020, when we just threw everything at the water with CARES Act, SBA loans, all of that. So this is nowhere near overheated, in my opinion. This trend that we're talking about, the US reindustrialization, that, just from the data, the metrics, the anecdotes, and the equity market signals, looks to me like it's working. This process is very early on. And if I had to call it right now, I'd say this is a durable trend. You probably as an investor lean into this. Right now, the main thing that looks like it could push it off the rails would be some abrupt change in who controls the keys in Washington, D.C., starting with the midterms this November. So it's a wait and see, but continue to watch for strength there. And then finally, the bank borrowing. Banks are also nowhere near their highs as far as just tapping bond markets. You've seen an uptick, but that's every quarter once the large banks, and you could say the regionals as well, who do issue fixed income securities, bonds in the public markets, they have to finish their earnings call, wrap up that process to get out of the blackout window. Then they go tap the debt markets. That's done as we've turned the corner from Q4 of 2025. They've begun tapping, fixed income markets. That's what that funding is providing. But once again, nowhere near the all-time high of where they were in by Q2 of 2023. So things are fine within the U.S. commercial banking system. I'd say the key thing to watch is that cash reserves. This is where the Fed wants to manage and make sure there's ample reserves, if you will, for banks to settle those transactions that are needed in a U.S. economy that is continuing to register kind of above trend growth. Uh, So next story I want to get
Yep.
to. This is the big one on the geopolitical front this week. Sunday we have the Japan snap elections. Um, Japan's Prime Minister Takaichi is looking to pick up seats in the Japanese Diet. This is a consolidation move to basically pull in, strengthen the majority. We'll get into the seat breakout here in a second, but we talked a little bit about Japanese insurance last week, right, Cameron? There's some sort, like, as JGB yields continue to rise, and they're going to. There's nothing to stop that trend. Um, the Japanese banking sector and the BOJ and the political kind of regime are all aligned that they are going to address and rein in inflation. What that effectively means is the Japanese yen carry trade, the number two source of funding scheme, financing, for lack of a better term,
Yeah.
capital liquidity pool in global markets. JPY is going away. Like the yen carry trade is not long for this world. What this political consolidation would do for the Takaichi version of the LDP, which is the successor to the Abenomics era or the Abe big sweep in the 2010s. This consolidation, in my opinion, what we were looking for is basically a shoring up of political consensus so that when the steps need or like come or when the market scenario arises where the steps need to be taken to address, say a mini crisis. I don't believe we're looking at a 2008 type of crisis that would hit your large banks, your financial institutions, all of that. I think those are safe. If you go back and watch last week's video, we described why it's really a regional banking impacting and
Private
Shinkin
credit.
banks, which are
Yep.
the analogs of credit unions, the insurance sector, and then the cross-border linkages on the reinsurance sector, which ties the Japanese life insurers to the US private credit sector. And we'll get into that in a chart in a second. But basically, what I view as happening, your largest capital pool in the offshore dollar system has basically been taken out behind the dumpster, shot in the head, and just thrown by the wayside. It's over. And that started, you could say, really in 2018 when we launched SOFR, went through a hiccup with COVID, and then with the rate hikes of 22, the deprecation of LIBOR, you had basically a full regime change of the new dollar order. There is no global offshore dollar anymore. Soon to be, there's no uh, global offshore yen carry trade available. Those are, if you're running a financing scheme and you have a core dependence on those debt markets to finance your own, um, just scheme, right? Uh, the only game town left is to mark up the gold. And that's what you're seeing with the central bank buying. So that is the explanatory power, like framework behind what's going on as gold has been in this uh, secular generational bull market, the repricing against fiat currencies, the dollar, the yen, but everything really. Um, that's what's happening is economies who are dependent on kind of cross-border economy or a foreign economy like the US or Japan to finance their own credit scheme. We're looking at you, Great British Pound and Euro, just to give a hint here. Those are gone, and now it's gold, right? And that's your only game in town.
Right.
Um, all right, so that's what we're looking for in Japan this week. If you look at what are the key thresholds, apologies, like just take it up with our producers, which are myself and Cameron, for putting the graphics together. Somehow that last red bubble didn't get pulled down to the 310 seats majority. These are the key cutoff numbers you're looking for on Sunday for where the LDP comes in. The basic ones, 233 seats. There's 465 seats in the Japanese Diet. 233 gives you a simple majority, 50% plus one, basically. That's a weak majority from parliamentary procedure. You can't do much, as we're kind of seeing in the US, right? This is where the US Congress is. You've got a Republican majority, like in name only, really, right? Because you're seeing kind of defections, people resign, they don't finish out their term. the U.S. majority in Congress is exceptionally weak. So this is where you don't want to be if you're in the LDP. 233 or anything close to that, you're in no man's land. You didn't really achieve anything. 243 is what would be considered a stable majority. All right, that's a little bit better, allows you to do more. You go through House committees for votes, all of that, and then the chairperson, which you would assume would be an LDP figure, would cast the deciding vote. That's better. Third cutoff would be 261 seats, an absolute majority. You could basically pass initiatives even without cooperation from opposition parties. So you just LDP only, right? We don't need to do anything. We don't need to appease some other sector, some
Great
faction, et cetera.
coalition. Yep.
Horse trading, right? There's always give and take in politics. And then this is probably not in the cards, but 310 seats would be a 2/3 majority, which is basically like ram it through. We can do whatever we want. This is like, I don't know, think NFL football, 3 yards in a cloud of dust. Like, we're going to run it right at you and you're not going to stop
Right.
it, that type of thing. So, this is just expectations. This is from Goldman Sachs. Reiki-san, love the names. Japanese culture, just getting to call people san, like with the san for Mister. It's just fun to do. Um, this is what we're looking at going in. So right now, LDP is at 198 seats. You've got like Ishin, which is I think that's a Japan Innovation Party. They've got 34 seats, very minor players, but it's enough to get them into that majority control they're in right now. Basically, right at that 233. They're at that simple, like basic majority at this point. Goldman's current call, at least this analyst sees LDP picking up 65 seats to get to 263. They do see Japanese innovation losing eight. So part of that is friendly fire, right? So you're on net picking up 57 in your coalition. And then you've got this other group, the CRA, the Centrist Reform Alliance, which is the CDP. I think that stands for Christian Democratic Party, but not sure. And then Komieto, which is, maybe this isn't proven yet, but they are definitely a CCP, mainland China friendly party or faction within Japan, is how I understand it. They're expected to lose. So the net trade-off here is expected to be some pickup for the Takaichi government that we've called them. They're the Japanese sovereigntist movement in our read of the world and how the geopolitics are laying out. What you're watching for on Sunday is that margin of victory. Anything above that, what was the cutoff?
Yeah, I was gonna say just
Um,
a
two
261.
two 261 is a good result, like a very good. If you can get to 310, that's like, call it impossible, but that would be cherry on top. That'd be everything you want if you're Takaichi. Anything below 243, not good. Okay,
Right.
so that's what we're watching for.
Just to round that
Markets will respond.
I
Yeah,
was
go
just saying,
ahead.
just to round that out really quick. I mean, I plugged in here Takaichi, even the news. I don't know if this is a specific lean to it or whatever, but only 20% of respondents to a poll said they're undecided. Even so, what as we look at these numbers, this is still with according to this polling, the majority of people have already kind of solidified where they're going to go in terms of parties to vote for.
That makes sense. We've been in this environment for 10 years. Japan's been in, they're coming out of a 30, 40-year depression.
They
So,
know
yeah, I
where
think
the puck is going.
people are pretty decided.
Yep.
As everything, don't listen to polling. The polls are not going to send you in the right direction. We won't get into that.
Yeah.
All right. All right. Number 11, or slide 11. Let's get into what everybody probably wants to talk about, the absolute carnage in Bitcoin, software companies, Mag 7s, private equity or private capital, private credit. So one thing I do want to call out, all right, yes, obviously Bitcoin crashing from 120, 124K, I think at the top back in July, August, or
126.
no, I
Yep.
think it hit in October. It was at an all-time high.
Yeah, I want to say so.
Um, yeah, for the daily. Um, it's just plummeting to 65,000, 66,000. We're hearing the eulogies being delivered on Bitcoin. This is, I mean, just par for the course. We've seen it before. hang in there, everybody who's just taken the abuse. What I do want to call out here, the correlation between your 2010s era SaaS software, cloud analytics. I was much younger then, 10 to 15 years younger, just coming out of, first few years out of college. Everything then was about cloud and SaaS. These were financed by ZERP policies, cheap money, um, central bank balance sheet expansion, all the above. With the think about the narratives we're seeing in the headlines this week. This week, it became really apparent to me. People are calling out the agentic AI creative destruction of all of that equity capital that was basically financed, built out, whatever, in the 2010s up until recently, right? So these cloud and SaaS software stocks. I've got the proxy up there with the First Trust Cloud Computing ETF, or SKYY, getting absolutely pummeled as well. If you model these analytically, daily returns, there's a pretty clear relationship. Basically, Bitcoin follows like a 1.5 beta if you measure your base as these cloud computing, software analytics plays. And if you plot those out, it's really the same trend, right? So if you've heard in the Bitcoin space, this big theme that everybody's hoping for, watching for, is the Bitcoin decoupling from the Nasdaq. That has not happened yet, and it continues to look like in this case. I think what we're seeing is a liquidity pullback. We've talked about the dollar cycle, the offshore dollar being restrained by the domestic U.S. Financial system and regulatory players. Now you're seeing that liquidity pullback from the yen. So this is a liquidity suck environment globally. Bitcoin itself is an FX pair. What you're seeing is Bitcoin getting sold to buy dollars. What that is reflecting is a need for liquidity just amongst players in the system. And then when you look at that tech stock decoupling theme, with Bitcoin's kind of ascent and first gaining its initial investor base of early adopters in the 2010s, there's a heavy overlap between, say, venture capitalists, tech entrepreneurs, individuals from that area. The portfolio holdings, if you look at your individual Bitcoin investor, they're probably someone who was also focused on technology investments in this 2010s era. All of that with this narrative on Moltbook and agentic AI just coming in. It's like, hey, those are, you're looking at a lot of zeros there, is what, financial headlines are telling you. So those are getting sold. There was a lot of credit basically backstopped and collateralized by these investments. So as portfolios go to sell, they get margin called, they need to raise dollars. And in this global kind of liquidity environment where we talked about offshore dollar, dead. Japanese, offshore yen carry trade, dead. All right, gold's running up as the only game in town to basically accommodate for that. But in that liquidity environment, and then these other themes, AI, creative destruction, and then you've also got to look at the U.S. economy. We're doing this industrial build out. That is balance sheet capital intensive, right? That takes dollar capital. So that reindustrialization is also sucking in liquidity for investment.
Right.
All of this is playing into the sell-off we're seeing in Bitcoin. I don't think it fundamentally reflects anything changed with the Bitcoin story. I've seen, funerals at every cycle. What I'm seeing, in our own kind of private business engagements, decisions being made, I wouldn't see these decisions happening. We'll just I won't get into them because they are non-public. But we wouldn't see these things happening if other firms involved in credit lending across global money centers didn't see a future continued Bitcoin ascent as where the puck is going in Wayne Gretzky terms.
Absolutely.
So for the longs out there, it is painful. This is, I don't want to make it a joke. Like nothing is funny about this. Um, but just ride it out. This is a cycle. And yeah, sorry we had to go through this pain, but this was part of the process. Tech stocks as well. I mean, technically everything, right? You even see a pullback on silver, gold, precious metals. Um, there is a rush to liquidity right now. Hopefully, I've described it. All of these things are playing into the fold, and Bitcoin is the liquidity tip of the spear. That is where kind of the brunt of the force is being funneled into and felt. So that's my opinion on what's going on. And Cameron, you have one more closeout on what we're seeing from Claude, new models in action here. That was
Yeah.
an interesting call out.
Yeah. Today, actually, the breaking news is that Claude released Opus 5.2. I personally use Claude a lot. I know, other people look at Codex for GPT, things like that. But the main difference here, I think it's very easy to get caught up in the, what's the new model? How's that going to affect, Intuit, whatever it is, which I put up previously. But I think what Matt is hitting on is the actual underlying trend that is happening. There is zero way, and you can see it on the chart, there is zero way that Claude Cowork release is what caused all of this, right? That's you're going to hear about it in the news. They're talking about the SaaS apocalypse. It's all because of Claude Cowork. I'm sure it adds to the story, but the trend that Matt is describing is the actual thing to be paying attention to.
Keep your wits about you. This is somebody's narrative. They want you to believe this. AI is real. It is going to be a very impactful technology, will be productivity enhancing. But this idea that Skynet's here, we're all going to be, I don't know, back to
Yeah.
serfs, field
it's,
servants.
it's not
Like,
there
let's
yet.
dial it back.
Yep.
Yeah, the apocalypse is not here. Uh, don't be surprised after this all plays out. Give it a few years. The world didn't end is basically what I'm saying here. All right, cool. So should we leave it there? I
Yep.
know there's real pain here. Bear through it, everybody, and keep your eyes watched or attached. Not mainly to the Super Bowl on Sunday, but in the background, flip to the Japanese elections for all the MindPrint Hash listeners out there.
Yep.
All right, let's close it up there.
Thank you,
Thanks,
everybody. And
everybody.
as always, feel free to like and subscribe to all of our videos. For those of you who are paying attention, we really recently moved to Substack off of Spotify podcasts for a few other reasons. But if you didn't realize that you weren't getting new episodes, reach out to me and let me know. That should have worked for all of you. But yep, again, as always, we're on Twitter or X now, YouTube at MindPrint Hash. All right, see you all next week.